Now available through your Trading 212 account is share lending, and in today's video we are going to explain everything you need to know about it. We're going to look at what it is, how it works, and even run through the actual screens you'll see on the app. I have to say this is really exciting, as for the first time ever as a retail investor, you have the ability to benefit from an arrangement that's actually been fundamental to how markets work for decades. You'll have full control too, being able to opt in and opt out freely. All the information is in the app itself in a super transparent way. Anyway, we'll get into all of that. But first, hello everyone, my name is Tom Morgan, a qualified financial advisor from That Finance Show. Today working in collaboration with the good people from Trading 212 who want to help you learn more about investing. Remember, as always, nothing in this video is financial advice. Okay, so let's start with what is it? Share lending is the process of a lender transferring their shares to a borrower. In return, the lender receives daily interest and collateral. With Trading 212, you can become a lender, lending your shares that you own to another person, the borrower. What you get in return for doing this is a share of some daily interest payments and something known as collateral to help minimise your risk as a lender. There's our first piece of jargon to deal with, collateral. Collateral is defined as an item of value pledged to secure a loan. In this case, with Trading 212, it's US Treasuries to the value of 102% of your share position, and this is updated daily. If in theory the borrower defaults on the loan, the lender can seize the collateral and sell it to recoup their losses. It's a bit like a mortgage on a house. If you stop paying the monthly payments, the lender has the house as security or collateral and can repossess it to sell it in order to recoup its money. Where is it available? Currently, it's only available in the UK, but is hoped to be rolled out later this year to other European areas. Watch this space. Oh, and it's only available in the Invest account, not your ISA. How does it work? Okay, so Trading 212 lends shares that you've bought and own in your portfolio to reputable borrowers and receives interest in exchange. They will then split all the interest they receive equally with you, 50-50. If you're thinking it sounds like just another thing you've got to deal with and might complicate running your portfolio, don't worry. This share lending is fully automatic and will never cause delays when you come to eventually sell your shares. How does share lending affect your position? In short, share lending won't impact your position at all. You can still close, modify, and add to your position if you want, even if your shares are lent out. It doesn't affect your trading in any way. Will all of your positions be lent out? Share lending, like most things really, is based on supply and demand. Shares with low availability, so not many of them, and that are in high demand, are more likely to be borrowed. Simply put, there's more people that would like to borrow some shares from you than others. Let me give you some examples here. Shares like Apple, Tesla, and say Microsoft are unlikely to be lent ever, but say Virgin Galactic, Beyond Meat, Carvana, and Lucid will likely have 100% lending. Oh, and there's no minimum or maximum amount that can be lent to. What happens to your dividends from shares that you lend out? I know this is a big thing many people will be concerned about, our precious dividends. Well, I have some good news here too. You won't lose out. You will still receive your entire dividend amount either as a dividend payment as normal or as something called a manufactured payment. Yep, I know what you're thinking. What's a manufactured payment? There's usually a process in place by brokers to recall the shares from the borrower just for the dividend date so your normal dividend payment can be made to you. When that doesn't happen is when you would receive a manufactured payment instead, so you don't lose out either way. The likelihood of you receiving a normal dividend or a manufactured payment is probably 50-50. A manufactured payment is when cash is delivered by the borrower of the shares instead of the original stock issuer to replace the dividend you would have ordinarily received. When it comes to tax, here in the UK, manufactured payments are treated in the same way as dividends would be and are taxed accordingly. However, in some countries they are taxed differently from regular dividends. I suggest speaking with a tax professional if you have specific questions about their taxation. Can you exercise your voting rights whilst your shares are lent out? No, this is one thing you cannot do. When your shares are lent out, you lose your right to vote with those shares. Why are shares usually borrowed and who borrows them? As we mentioned earlier, share lending and borrowing has been a fundamental way to how markets work for years. It enhances market liquidity, making more shares available for buying and selling, and simply helps supply meet demand and keeps everything working efficiently. Shares are also often borrowed for the purpose of short selling. If traders borrow shares to sell them short, they expect the share value to fall and aim to profit from a price drop. Short selling often gets bad press, and a lot of you will remember the GameStop saga in recent times as an example of this practice. But in truth, short selling often helps correct overpriced stocks and ensures prices better reflect a company's actual value. Short selling is a whole other topic entirely. We'll look to make a separate video on this. In terms of who borrows them, pensions and insurance funds, ETF issuers, banks, brokers, all of them have been doing this for years. Trading 212 is giving you the exciting opportunity to benefit from it for the first time as a retail investor. Do you still own the shares that have been lent? Yes, to be clear, you remain the beneficial owner of the shares. This means that you still benefit from any rise in the value of the shares or lose when the share price falls, and they are still yours to sell in the future if you decide to. What are the risks? Like with any investment decision, share lending carries risks, and Trading 212 are keen to ensure you understand what they are before you go ahead. Firstly, there's a risk that the borrower doesn't return the shares you lent to them. That's what the collateral is there to cover. The value of your shares changes over time, so it's important the collateral changes too, so it is always there to do the job it is designed to. Remember, the collateral is worth 102% of the value of your shares and is adjusted daily for this reason. There's also always the risk that Trading 212 and all parties involved go bust. For peace of mind, you are protected under the Financial Services Compensation Scheme, FSCS, to the value of £85,000 for this purpose. And finally, we've mentioned it already, but don't forget, you will lose your voting rights and be aware that the shares you lend out might be used for shorting. Where can you learn more about share lending? The International Securities Lending Association, ISLA, has an excellent video on the basics of share lending, which we'll link in the description to this video. Well worth 5 minutes of your time if you want more information. How do I set it up? Right, let me take you through the screens on the Trading 212 app so you can see how to set this up and what it looks like. Just before I do, it's worth pointing out that once you've registered for this service, it takes a couple of days after sign up before you'll start to see interest coming through. So don't worry if you don't see some interest coming through instantly. So once this is available in your region, you'll see this on your app, a notification screen that says Earn Daily Interest with a button to click to learn more. Firstly, it will tell you briefly how it works, the collateral, etc. Next, it will confirm it's all automatic and happens in the background for ease of use. No restrictions on trading, and confirms you'll still get your dividends in full. Everything we've covered in this video, really. It then confirms that you'll be able to see in the app which stocks of yours are lent out and how much interest you're getting for complete transparency. You'll see what this looks like in a minute. And finally, that you can disable the feature if you change your mind in the future too, no problem. It'll take a couple of days to wind down, but you're not committed for any period of time with this feature. You'll then be taken to this rather handy calculator where you can play with the parameters and see how much interest you could earn. Pick a stock across the top, enter the value of lent shares and the duration, and there you go, a projection of your potential interest. These next screens just take you through the risks, as we mentioned earlier, just to make sure you're absolutely aware and comfortable with these before proceeding. And then you'll get a statement about dividend tax and how this might be treated, followed by the final screen where you'll need to confirm you've understood it all by tapping I confirm. And there you go, share lending enabled. Here's the share lending page you'll be presented with. You've got an overview, which is this page, a payments tab, and finally a most borrowed tab. All the info you need. So, there you go. I hope that was useful. If there was anything we didn't cover or any questions left unanswered, please leave a comment down below and we'll do our best to answer them. My name is Tom Morgan from That Finance Show. See you soon and thanks for watching.